Are you obsessed with having a high win rate but still can't grow your account? Today, we're taking a break from trading systems and indicators to talk about money management. I've wanted to make this video for a long time, but I couldn't find the right opportunity. Before we start today's video, if you'd like to receive offers on courses, exclusive tools and indicators from Rober, as well as market information and signals for gold and Forex, you can join the community via link pinned in video description. And of course, everything is completely free. Today is the right time for us to understand the relationship between win rate and reward risk ratio. Let's get started. Before we begin, I'd like to briefly review reward risk ratio. I already have a full video about it on my YouTube channel, so you can always go back and watch it. Reward risk ratio, or RRR, is the ratio between the potential reward and the amount of risk we take on a trade. If we write it as a formula, it looks like this. R equals reward divided by risk. Reward is the profit we expect to make. Risk is the amount we're willing to lose if the trade goes against us. Simply put, reward is the profit we want to earn, and risk is the loss we're willing to accept. Let me give you an example. Suppose we buy a stock at 1,000. We plan to sell it when the price reaches 1,600. This is our take profit. On the other hand, we also need to set a stop loss. Our stop loss is at 800. In other words, we buy at 1,000, take profit at 1,600, and cut the loss if the price falls to 800. Now let's calculate the reward risk ratio. We simply use the formula, reward divided by risk. Our expected profit is 600 because we bought at 1,000 and plan to sell at 1,600. Our risk is 200 because if the price falls to 800, we'll lose 200. Therefore, the reward risk ratio is 3-to-1. That's the simplest way to calculate reward risk ratio. Now let's look at a real example on a price chart. On this chart, you can see that the price keeps dropping, then bouncing, dropping again, and bouncing again. It looks like the price is moving back and forth between support and resistance. Let's assume this is the current price. At this point, we need to decide whether we should buy. The first step is to identify the support and resistance levels. This line is our support. The price has dropped to this level several times and bounced back each time. Even when there's a long lower wick, the price still bounces from this area. That tells us it's a strong support level. Next, we identify the resistance. The price has tested this level 3 times but failed to break above it. So, if we decide to buy here, our stop loss should be placed below the support, and our take profit should be placed near the resistance. Let's calculate it. The current price is around 38,000. This is our entry price. The support is around 35,000, so we'll place our stop loss there. Our take profit is around 44,000. Now, let's calculate the reward risk ratio. Our risk is 3,000 because we'll lose 3,000 baht if the stop loss is hit. Our reward is 6,000 because we're aiming for 44,000 baht. That gives us a reward risk ratio of 2-to-1. A 2-to-1 reward risk ratio is something I use very often. However, something is even more important than having a 2-to-1 reward risk ratio. Will the price actually reach our take profit? That's something we haven't talked about yet. Right now, the price is around 38,000. There's no guarantee that it will actually reach 44,000. So even though the reward risk ratio looks good, we still don't know whether the market will reach our target. Let's look at another example. In this example, the market is in a downtrend. If we draw a trend line, you'll notice that the price is currently breaking above it. One common trading strategy is to buy when the price breaks above a trend line. Once we decide to buy, we first identify the support level. The clearest support is this swing low. Next, we identify the resistance. There are several possible resistance levels. This could be 1. This could also be 1. For this example, let's be optimistic and choose the higher resistance level. Once we have our support, resistance, and entry price, we can calculate the reward risk ratio. Our entry price is around 65. The stop loss, or support, is around 45. Our take profit is around 100 baht. That means our risk is 20 because we enter at 65 and place the stop loss at 45. Our expected reward is 35 baht because we're targeting 100. Therefore, the reward risk ratio is 1. 75 to 1. That's still considered a fairly high reward-risk ratio, since many traders use around 5 to 1. But the question is still the same. Will the price actually reach our take profit? Right now, the price has just broken above the trend line. However, the overall market is still in a downtrend. There's still a chance that the price will continue moving lower. That makes this take profit look quite far away. This brings us to an important point. Everyone wants a high reward-risk ratio, such as 5 to 1 or 10 to 1. But in reality, many people forget one thing. The higher the reward-risk ratio, the harder it is for the price to actually reach the target. Let me give you two examples that have nothing to do with trading. Remember, a high reward-risk ratio does not guarantee that it's a good investment if the probability of winning is very low. On the left side is a lottery. On the right side, let's assume we're selling grilled meatballs at a local market. Let's start with the lottery. Suppose one lottery ticket costs 100. That 100 is our risk. If we win the first prize, we expect to make a profit of 6 million baht. In this case, our reward-risk ratio is 60, 0 to 1. That's an incredibly high reward-risk ratio. Now let's look at the grilled meatball business. First, we have to invest. We need to buy the meatballs, the skewers, and prepare the sauce. Let's say our total investment is 2,000. If nobody buys anything, we'll lose the entire 2,000. However, if the meatballs taste good and everything sells out, we might make 4,000. In this case, our reward-risk ratio is 2 to 1. If you only focus on the numbers, 60, 0 to 1 seems much better than 2 to 1. But that's not how investing really works. Something just as important as the reward-risk ratio is the win rate. On the left side, the chance of winning the lottery is extremely small, about 1 in a million. On the right side, the probability of making a profit by selling food is much higher. So, reward-risk ratio alone is not enough. We also need to consider the win rate. Today, I'll show you what win rate is and how it relates to the reward-risk ratio. Win rate simply means the percentage of winning trades. For example, if you take 100 trades and win 30, your win rate is 30%. Here's another example. Suppose you only take 10 trades, but you win 7 of them. Your win rate is 70%. Now here's something that surprises many people. Most professional traders only have a win rate of around 40% to 50%. You might wonder how that's possible. How can they make money if they lose more trades than they win? Here's the answer. Suppose a trader has a 40% win rate. That means out of 100 trades, they only win 40, but they lose 60. So how do they still make money? It's simple. Every time they win, they make a large profit. Every time they lose, they keep the loss as small as possible by using a stop loss. Making large profits while keeping losses small, that's exactly what the reward-risk ratio is all about. Now you can clearly see how win rate and reward-risk ratio work together. The next question is this. Suppose you've backtested a trading system and found that it has only a 40% win rate. How do you calculate the reward-risk ratio you need? Let's find out. Now I'd like to introduce a concept from statistics and mathematics that many of you probably learned back in high school. It's called expected value. Literally translated, it means the expected value or expected outcome. In mathematics, however, it refers to the weighted average of all possible outcomes based on the probability of each outcome occurring. It may sound a little confusing at first, but after looking at 3 examples, it will become much clearer. Before we begin, I'd like to apologize in advance because there will be a simple mathematical formula. Don't worry, it's not complicated. Once you understand it, you'll be able to apply it not only to investing, but also to many situations in everyday life. The formula looks like this: EX equals SX times P. Here, each term represents one possible outcome. Let's briefly explain the variables. E is the expected value. X is the outcome, such as making a 200 profit or losing 20. P is the probability of that outcome occurring. For example, there might be a 20% chance of making 200 or an 80% chance of losing 50. Now that we understand X and P, let's look at some examples. Before we start, I'd like to emphasize that the following examples are used only to explain mathematical and statistical concepts. They are not intended to encourage or promote gambling in any way. Let's begin with example 1, which is flipping a coin. Suppose we play a game that costs 20 per round. If we choose heads and the coin lands on heads, we win 20. If we choose heads but it lands on tails, we lose 20. Now let's apply the expected value formula. The first outcome is winning. X is the amount we win, and P is the probability of winning. The second outcome is losing. X is the amount we lose, and P is the probability of losing. Since a coin only has two possible outcomes, either heads or tails, we only need these two terms. The formula becomes much simpler. For a coin flip, the probability of winning and losing is the same, 50%. A 50% probability is written as 0.5. The probability of losing is also 0.5. Now let's substitute these values into the formula. If we win, we gain 20 baht, so X equals plus 20. The probability of winning is 0.5. If we lose 20 baht, so X equals negative 20. The negative sign represents money leaving our pocket. The probability of losing is also 0.5. Now, let's calculate it. Adding them together gives us 0. So what does an expected value of 0 mean? It means that, over the long run, this is a break-even game. You might win the first round, win again, lose the third round, or experience different winning and losing streaks. But if you keep playing thousands or even tens of thousands of times, you'll eventually break even. You won't make money, and you won't lose money. Now let's look at example 2. Suppose we're buying a 2-digit lottery ticket. We can choose any 2-digit number, such as 85, 56, or 42. For every 1 baht we spend, if we win, the lottery pays 70. If we lose, we only lose 1. At first glance, this looks very attractive. We risk 1 baht for a chance to win 70. That gives us a reward-risk ratio of 70 to 1. Now let's calculate the expected value. First, we need to know the win rate, or the probability of winning. For a 2-digit lottery, the probability of winning is 1 out of 100. Why? Because there are 100 possible numbers. From 0, 0 to 99. Only one number wins. Therefore, the probability of winning is 1 over 100, or 0.01. The probability of losing is everything else. If the winning number is 56, then buying 55, 57, or any other number still loses. So the probability of losing is 99 out of 100, or 0.99. Now that we know the probabilities, let's substitute them into the formula. If we win, we receive 70. The probability of winning is 0.01. If we lose 1. The probability of losing is 0.99. After calculating the formula, the expected value is negative 0.29. The negative sign tells us that we'll lose money over the long run. In other words, every time we spend 1 baht on the lottery, we lose an average of 0.29 in the long run. The more money we spend, and the longer we keep playing, the more money we'll eventually lose. Let me give you another example to make this even easier to understand. Imagine there are 100 different lottery numbers arranged in a 10 x 10 grid. Suppose you've never won before, so this time you decide to buy every single number. Each ticket costs 1, so you spend a total of 100. Now the drawing takes place. No matter which number wins, you'll definitely have the winning ticket. Suppose the winning number is 42. Yes, you've won. But how much does the lottery pay? It still pays only 70. What about the other 99 tickets? They win nothing. So, in the end, you've spent 100, but you've only received 70 back. That means you've lost 30. This is exactly the same idea as the previous calculation. The probability of winning is very low, while the probability of losing is very high. Now let's look at example 3, which involves rolling 2 standard 6-sided dice. Each die has numbers from 1 to 6. We roll both dice at the same time. First, let's look at the rules of the game. We add the numbers from both dice together. The smallest possible total is 2. which is 1 plus 1. The largest possible total is 12, which is 6 plus 6. So every possible result falls between 2 and 12. If you've ever rolled 2 dice, you'll notice that some numbers appear more often than others. Now here's the rule. If the total is exactly 7, we win 70. If the total is any other number, we lose 10 baht. Here's my question. Would you play this game? You roll 2 dice. If the total is 5, you lose 10. If it's 9, you lose 10. But if it's 7, you win 70. Would you play? If you'd like to think about it yourself, pause the video here. Go back and review examples 1 and 2, then try calculating the answer. If you can solve it yourself, it means you've understood the concept and you're ready for the next step. If not, don't worry. Let's go through the solution together. This concept is very important because we'll use it to connect reward-risk ratio and win rate in trading. Let's find the answer. When rolling 2 dice, the total can be anywhere from 2 to 12. Here's the probability distribution. A total of 2 can only happen one way, 1 plus 1. A total of 3 can happen 2 ways, 1 plus 2 or 2 plus 1. A total of 4 has 3 possible combinations. A total of 5 has even more combinations. The number of combinations keeps increasing until we reach 7. A total of 7 has the highest probability, with 6 possible combinations. After that, the number of combinations gradually decreases. A total of 12 has only one possible combination, 6 plus 6. If you count every possible outcome, there are 36 combinations in total. Only 6 combinations produce a total of 7, which means only those combinations are winning outcomes. The other 30 combinations are losing outcomes. If we roll a 10, we lose. If we roll a 3, we lose. Only a total of 7 wins. Now we can calculate the probabilities. The probability of winning is 6 out of 36, which is approximately 0.167. The probability of losing is 30 out of 36, which is approximately 0.833. Now substitute these values into the expected value formula. If we win, we receive 70 baht with a probability of 6 over 36. If we lose 10 baht with a probability of 30 over 36. After calculating the formula, the expected value is plus 3.33. The positive sign means we make money over the long run. The larger the positive expected value, the greater the long-term profit. So if someone offered you this game, you should definitely play it. Over time, you would make money. Now that you're ready, let's go back to our original question. How do we know what reward-risk ratio we need if our trading strategy has a 40% win rate? Here's how we calculate it. For any trading strategy, if the win rate is 40%, then the probability of winning is 0.4. The probability of losing is 60%, or 0.6. Now let's look at the reward-risk ratio. The reward is simply the amount we make when we win, while the risk is the amount we lose when we're wrong. These are the X values in the expected value formula. Let's assume that every winning trade makes R baht. We don't know the exact amount yet, so we'll call it R. Every losing trade loses 1 baht. This is just an assumption to make the calculation easier. Now substitute everything into the formula. The probability of winning is 0.4. The probability of losing is 0.6. The winning outcome is R. The losing outcome is -1. Now remember what we learned earlier. If the expected value equals 0, we break even. We neither make money nor lose money. So we set the equation equal to 0 and solve for R. The answer is R equals 1.5. What does that mean? It means that if your trading strategy has a 40% win rate, you'll break even with a reward-risk ratio of 1:5 to 1. Therefore, if you want to make money with a 40% win rate, your reward-risk ratio must be at least 1:5 to 1, or even higher. For example, if your win rate is 40% and your reward-risk ratio is 2 to 1, you'll make money over the long run. Of course, it's not easy to achieve those numbers. Sometimes your win rate is 50%, but your reward-risk ratio is only 1 to 1. In that case, you won't make much progress. Now, you might have another question. Suppose your trading system has a 45% win rate. What reward-risk ratio do you need? You can simply use the same method we just went through. Or, if you want something easier, I have two shortcut formulas for you. These two formulas are actually the same equation, just rearranged into different forms. Here, R stands for reward-risk ratio, and W stands for win rate. If you substitute one variable into either formula, you can solve for the other. For example, if you know R, you can calculate W. If you know W, you can calculate R. Let's look at an example. Suppose your target reward-risk ratio is 2 to 1, just like the one I use most of the time. What win rate do you need just to break even? Simply substitute R equals 2 into the formula. The equation becomes W equals 1 divided by 1 plus R. Substituting 2 gives us 1 divided by 1 plus 2 equals 1 divided by 3. As a decimal, that's 0.333, or 33.33%. That's the minimum win rate you need to break even with a 2 to 1 reward-risk ratio. You don't necessarily need a very high win rate. If your reward-risk ratio is good enough, even a relatively low win rate can still make you profitable. On the other hand, if you have both a high win rate and a high reward-risk ratio, your profits can become enormous. I also have a table for you. It's called the break-even table. Here's how it works. If your reward-risk ratio is 1 to 1, you only need a 50% win rate to break even. If your reward-risk ratio is 5 to 1, you only need a 40% win rate. The higher your reward-risk ratio, the lower the win rate you need to break even. Some traders aim for a 10 to 1 reward-risk ratio. With a reward that large, they don't need to win very often. Each winning trade is worth 10 times the risk. You can use this table to evaluate your own trading strategy. I also have another table that's even easier to use. With this table, you don't have to calculate anything. The green area represents profit. The yellow area represents break-even. The red or orange area represents loss. Simply find your win rate, then look across to your reward-risk ratio. For example, if your win rate is 45% and your reward-risk ratio is 1 to 1, you'll lose money. However, if your win rate is 45% and your reward-risk ratio is at least 5 to 1, you'll be profitable. As your reward-risk ratio increases, your potential profitability also increases. And as I mentioned earlier, if your trading strategy has a 70% win rate, almost any reasonable reward-risk ratio will still make money. For me personally, most of my trading systems have a win rate of around 40% to 50%. That's why I usually set my reward-risk ratio at 2 to 1. With a 40% win rate, a 2 to 1 reward-risk ratio is still profitable. With a 50% win rate, it's even more profitable. That's how most of my trading systems work. I've never really had a trading system with a win rate higher than 50%. Finally, some of you may still be wondering how to apply all of this to a real chart. That's exactly what I'll cover in the next video. It's a video you definitely don't want to miss. After watching it, you'll be able to decide whether the chart you're looking at is actually worth trading. For example, I'll show you two charts. One is on the left and one is on the right. Which one would you choose to open a short position? On the left chart, the price has just reversed from resistance. However, it could simply be a pullback before continuing higher. On the right chart, after waiting another 4 days, the price has clearly moved lower. At this point, it looks much more likely that the downtrend is real. Would you open a short position here? If you short the left chart, you have the opportunity to make a much larger profit, but there's less certainty. If you short the right chart, your profit potential is smaller, but the probability of success is much higher. That's the relationship between reward-risk ratio and win rate. Are you tired of staring at the charts all day, only to end up overtrading and losing money? What if you could catch the biggest moves with just a few minutes of chart analysis each day? With this trading system, you won't need to trade frequently, and you won't have to spend long hours watching the charts. That's because this system is based on the principles of swing trading. Let's begin by understanding what swing trading means. Before we start today's video, if you'd like to receive offers on courses, exclusive tools and indicators from Rober, as well as market information and signals for gold and Forex. You can join the community by via link pinned in video description. And of course, everything is completely free. Swing trading is a type of trading strategy. This strategy focuses on capturing profits from individual market swings. In each swing, we usually hold a position for several days or even several weeks. Most of the time, we enter a trade when the market is trending. We enter the trade when the price makes a pullback. Let me show you an example. Here's the chart. The time frame is the one-day time frame. At a quick glance, you can already see that the market is in an uptrend. Along the way, the price keeps moving up and then pulling back repeatedly. For example, on the left side of the chart, the price rallies sharply. After that, the price makes a pullback. In swing trading, this is the area where we look for an opportunity to enter a trade. The lowest point of the pullback is called the swing low. This is exactly the concept behind our swing trading strategy. Once we enter a buy trade, the price has the opportunity to continue moving higher. After rising for a while, the price may pull back before continuing upward again. We simply stay with the trend. We don't close the trade until an exit signal appears. The signal looks like this. You can see that I've marked two highs. The second high is the most recent high. Notice that the price is no longer able to make a new high. That means the momentum is likely fading. This is the time to look for an opportunity to exit the trade and lock in our profits. If we can enter the trade near the beginning of the trend or during the pullback, we have a good opportunity to make a substantial profit. For example, suppose the price starts moving higher from this point. We can enter a buy trade here. After that, we simply follow the trend as the price continues to rise. Eventually, when the price loses momentum at this point, we exit the trade. This is the profit we can make. Now, if we look at the chart and compare it with the actual point where we entered the trade, we'll find that our profit becomes much smaller. This is one of the most important questions in swing trading. When should we enter a trade? How do we know whether the price has pulled back deeply enough to be a good buying opportunity? There are several ways to determine this. The first method is to use Fibonacci retracement. The principle is simple. First, identify the swing. The lower point is the swing low, and the upper point is the swing high. Then, mark them as 0% and 100%. The 0% level represents the point before the price starts pulling back. The 100% level represents a complete retracement back to the swing low. Next, look at the Fibonacci levels. These numbers represent the percentage of the price retracement. In most cases, we look for buying opportunities when the price is retraced more than 50%. The reason is simple. When the price pulls back deeply, we have the opportunity to buy at a better price. For example, this area is considered the golden zone. Ideally, the price should retrace between 50% and 61.8%. In this example, the price retraces perfectly into this zone. We can enter a buy trade here. After that, the price continues moving higher. The second method for determining whether the price has pulled back deeply enough is to use the smart money concept. The principle is also straightforward. If you look at the left side of the chart, you'll see that the price breaks the market structure by making a new high. At this point, a fair value gap, FVG, may be created. We simply wait for the price to retrace back into that fair value gap. If you've watched my previous videos, you'll know that this fair value gap should be located within the discount zone. That means the price has already retraced more than 50%. Therefore, once the price returns to the fair value gap, we can enter a buy trade. After that, the price continues moving higher again. These two methods are the basic techniques that most traders use to measure the depth of a pullback. However, today I'd like to introduce another technique. I call this technique the EMA channel. The EMA channel uses two EMA lines to identify both the market trend and the depth of the price pullback. For example, I have two EMA lines on the chart. The white line is the EMA 20. The blue line is the EMA 50. You'll notice that the space between these two EMA lines forms a narrow channel. This is what we call the EMA channel. When the market is in an uptrend, the price moves higher and periodically pulls back. When the price pulls back, it enters the EMA channel. For example, in this red area, the price is already inside the EMA channel. From there, we look for an opportunity when the price bounces out of the EMA channel. Once the price reacts to the EMA channel and continues moving higher, we can enter a buy trade. Let's look at the same chart again. This is the same chart we used earlier to explain Fibonacci retracement and the smart money concept. This time, we'll use the EMA channel to measure the pullback. Simply add the two EMA lines to your chart. The white line is the EMA 20, and the blue line is the EMA 50. You'll notice that the price pulls back directly into the EMA channel. Once the pullback is complete, we wait for the price to bounce. When the price breaks back above the EMA channel, we can look for an opportunity to enter a buy trade. Today's swing trading strategy consists of 4 steps. The first step is trending market. We only look for trading opportunities when the market is trending. It can be either an uptrend or a downtrend. To identify the trend, we use the relationship between the price and the EMA lines. For an uptrend, the price must be above the EMA 20, and the EMA 20 must be above the EMA 50. In other words, the order should be price EMA, 20 EMA 50. In addition, we also need to check the slope of the EMA lines. The EMA lines should have a clear slope. Visually, it's like walking uphill. The steeper the hill, the better. If the hill starts becoming flat, it's a sign that we should stay away from that market. The same concept applies to a downtrend. The price must be below the EMA 20, and the EMA 20 must be below the EMA 50. As shown in this example, the price follows this order most of the time. Just like in an uptrend, the EMA lines must also have a clear slope. In this case, the overall market is in a downtrend, so the slope is negative, like walking downhill. Now let's look at another example. At first glance, this appears to be a downtrend. However, the slope of the EMA lines is not clear. There are periods where the market moves downward without much momentum. There are also periods where the market becomes flat. Therefore, we avoid this type of market. Here's another type of market that we should avoid. This is a sideways market. You can tell by looking at the relationship between the price and the EMA lines. The price keeps crossing above and below the EMA lines. Sometimes the price stays above the EMA, and then it crosses below it. In other areas, the price moves sharply up and down. First, it rallies strongly. Then it reverses downward. After that, it rallies again. This type of market should also be avoided. Now, let's move on to step 2. This step focuses on the pullback into the EMA channel. There is one very important rule. The price must not close beyond the EMA 50. If the price closes beyond the EMA 50, there's a possibility that it will continue moving in that direction without reversing. Let's look at an example. This is an uptrend. There are several pullbacks into the EMA channel. There are 3 possible pullback patterns. The first pattern is when the price pulls back but never reaches the EMA channel. In this case, we do not enter the trade. Even though we miss the move, we simply let it go. The second pattern is when the price pulls back and closes inside the EMA channel. This is exactly what we're looking for. We prepare to enter the trade and expect the trend to continue. The third pattern is when the price pulls back and closes below the EMA channel. In this case, we also stay out of the trade because the price may continue moving lower. Let's look at this chart. At this point, the price pulls back and closes inside the EMA channel. After that, the market spends about 1 week consolidating before bouncing higher. That is when we look for an entry. Here's another example on the right side. The market is in a strong uptrend. Then the price starts pulling back. If you look carefully, you'll notice that this is the first pullback pattern. The price pulls back but never reaches the EMA channel. There isn't a single candle that closes inside the EMA channel. Therefore, we do not enter the trade. Now let's look at another example. In this chart, the price pulls back 3 different times. The first pullback, on the left side, never reaches the EMA channel. There is one candle with a long wick. However, the candle does not close inside the EMA channel, so it doesn't count. Later, the price moves higher and then pulls back again. This time, it meets our criteria. The price closes inside the EMA channel, and no candle closes below the EMA 50. Therefore, we can look for a buying opportunity. Finally, on the far right, the price pulls back very aggressively. This setup does not meet our criteria because several candles close below the EMA 50. Since it fails the rules, we do not enter the trade. The rules are exactly the opposite for a downtrend. The price can pull back in all three ways, but we only take the setup where the price closes inside the EMA channel. In these examples, the price closes inside the EMA channel, so the setups meet our criteria, even if there is a small bullish candle closing above the white EMA line. After that, the price reverses lower and continues into a strong downtrend. However, not every pullback qualifies. In the next example, the first pullback passes because the price closes inside the EMA channel. The second pullback is much deeper and closes above the EMA 50, so it fails our criteria. Even though the market eventually continues downward, we still do not take the trade because it doesn't follow our trading rules. The final pullback also fails because the price breaks above the EMA 50 twice. Now let's move on to step 3. Once steps 1 and 2 have been satisfied, we look for confirmation. We wait for either an outside bar or an engulfing pattern with a large candle body. In this chart, step 1 confirms an uptrend, and step 2 is satisfied because the price closes inside the EMA channel. Next, we wait for the price to bounce and close back above the EMA 20 while forming a valid outside bar. For an outside bar, the second candle must have a wider opening and closing range than the first candle. In continuously traded markets or on lower time frames, we also accept a bullish engulfing pattern, where the second candle completely engulfs the previous one. The key requirement is a bearish candle followed by a bullish candle. Looking back at the chart, the first bullish candle is still an inside bar, so we do not enter the trade. A little later, another bearish candle closes inside the EMA channel, and the following candle forms a bullish engulfing, which also qualifies as an outside bar. This setup meets all of our criteria, so we can enter the trade at the close of that candle or at the open of the next one. For a downtrend, we use exactly the same idea in reverse. First, steps 1 and 2 must be satisfied. The market must be in a downtrend, with the price and EMA lines properly aligned, and the price must pull back and close inside the EMA channel. Then we wait for the price to reverse downward and close below the EMA 20 while forming a valid outside bar or bearish engulfing. The second candle must completely engulf the previous one. In this example, the next candle still closes inside the EMA channel, so we continue waiting. The following candle forms a bearish engulfing, meets all of our criteria, and we can enter a short position immediately at the close of that candle or at the open of the next candle. The final setup, step 4, is what makes this swing trading strategy unique. In swing trading, we stay with the trend for as long as possible. Therefore, our exit strategy, or take profit, TP, is also unique. We use a trailing stop by continuously moving our stop loss along with the trend. Eventually, when the price comes back and hits our stop loss, we exit the trade. Let's look at an example. It may seem a little complicated at first, but it's actually quite simple. At this point, we've just entered a trade after all 3 previous conditions have been satisfied. We use a trailing stop to protect our profits. The first step is to place the stop loss below the swing low. Whenever the price pulls back into the EMA channel, it naturally forms a swing low. Therefore, we can place our stop loss below that point. Next, we set our first take profit target. We use a risk-to-reward ratio, 201:1. Whatever the size of our stop loss, our take profit is the same distance. This becomes our first TP. Some of you may wonder why we only use a 1:1 risk-to-reward ratio. The reason is very simple. We want the price to reach our first take profit. Once it does, we close 50% of the position. This step is extremely important. We secure profits on half of the trade first. The remaining half of the position is left to follow the trend. We hope the trend continues for a long distance so the second half can generate much larger profits. Once we've secured profit on the first half, we move our stop loss to the entry price. In other words, we move the stop loss from below the market to our original buy entry. At this point, if the price reverses and hits our stop loss, the remaining half of the position closes at break even. We neither gain nor lose anything on that remaining half. However, we've already locked in profits on the first half. So even if the market only moves a little, we still make money because half of the position has already been closed in profit. If the trend continues much further, then the remaining half can produce a very large gain. Don't forget that whenever the price makes another pullback, we use that new swing low as our new stop loss level. In other words, we keep moving our stop loss upward as the trend progresses. For example, when the price creates a small swing low, we move the stop loss up to that level. When another higher swing low forms, we move the stop loss again. We continue doing this until the trend eventually ends. When the price finally reverses and hits our stop loss, we exit the trade. The same concept applies to short trades, but in reverse. After opening a short position, we place the stop loss above the swing high that forms while the price pulls back into the EMA channel. As a result, the initial stop loss is usually fairly large. Next, we set a 1-to-1 risk-to-reward ratio and place our first take profit. This first take profit is used to secure profits on the first 50% of the position. If the price continues moving downward and reaches our take profit, we close half of the short position. The remaining half stays open. Then we begin using a trailing stop. The first step is to move the stop loss down to the original short entry price. After that, whenever the price continues downward and forms another pullback, we move the stop loss lower accordingly. If all 4 steps meet the required conditions, then you have a valid swing trading setup. Since this setup is fairly simple, I'll only show you 3 examples. Let's start with the first one. In this example, we first check, step 1, the price must be aligned with the EMA lines. The price is above the EMA 20, and the EMA 20 is above the EMA 50, so it meets the first condition. Next is step 2. The price must pull back and close inside the EMA channel. In this example, the very first pullback satisfies this condition perfectly. After that, we wait for an outside bar with a large candle body. The very next candle is indeed an outside bar. It becomes a large bullish candle that closes above the EMA 20. Therefore, this setup meets all of our criteria. We can enter a buy trade immediately. Once we're in the trade, the first step is to place the stop loss and take profit with a 1-to-1 risk-to-reward ratio. The stop loss is placed below the previous swing low, which is the area highlighted in red. After that, we simply wait for the price to reach our take profit. Once it does, we close 50% of the position. Then we start using a trailing stop. We move the stop loss up to our original buy entry. In this example, it's along this line. From there, we simply stay with the trend as the price continues moving higher. After some time, you'll notice another pullback. When that pullback forms, we move our stop loss up to the new swing low. If the price continues higher and forms another pullback, we move the stop loss again. Eventually, the market keeps trending upward. The remaining 50% of the position generates a substantial profit. Now let's look at the second example. This is still an uptrend. First, we check whether the price is properly aligned with the EMA 20 and the EMA 50. Just by looking at the chart, we can clearly see that everything is properly aligned. Next, the price must pull back and close inside the EMA channel. On this chart, the price does exactly that. Now we move on to step 3. We wait for an outside bar with a large candle body. As we move forward through the chart, we eventually find this pair of candles. This is an outside bar. The bullish candle closes above the EMA 20. Therefore, the setup meets all of our conditions. We can enter a buy trade immediately. After entering, we follow the exact same process. Place the stop loss below the swing low and place the take profit at a 1-to-1 risk-to-reward ratio. Just 2 candles later, the price reaches our take profit. We've already secured profit on the first 50% of the position. Next, we activate our trailing stop. The first step is to move the stop loss to the entry price. Starting from this point, every time the price moves higher and then forms a pullback, we move the stop loss accordingly. Here's the first adjustment. The next adjustment is here. After that, the price pauses briefly before continuing higher. We can move the stop loss again here. Eventually, on the right side of the chart, the price shows signs of reversing. When we finally exit the trade, the remaining position is closed at the latest trailing stop level. Now, let's look at the final example, which is a downtrend. We simply reverse the entire strategy. First, the price must be below the EMA 20, and the EMA 20 must be below the EMA 50. Next, the price must pull back and close inside the EMA channel. On the left side of the chart, the price pulls back above the EMA 50, so this setup does not meet our criteria. We continue waiting until the next pullback. This time, the price forms a small bullish candle that closes inside the EMA channel, so the setup is valid. Finally, we wait for a large bearish candle that engulfs the previous bullish candle. Once it appears, we can enter a short position. Don't forget to place the stop loss above the swing high form during the pullback and set the take profit at a 1-to-1 risk to reward ratio. When the price reaches the first take profit, we close 50% of the position and leave the remaining 50% open. Then we use a trailing stop, first moving the stop loss to the original short entry and later moving it lower whenever a new pullback forms. Eventually, when the price reverses and hits the stop loss, we close the remaining half of the position. In some trades, the second half may generate much larger profits if the trend continues farther. Now let's answer one of the most common questions. Why do we use the one-day time frame? The main idea behind this strategy is swing trading. We don't want to spend all day watching the charts. We only need to check our positions once a day. For example, on day 1, the market may only satisfy the first condition, so we simply add it to our watch list and check again the next day. On day 2, if both steps 1 and 2 are satisfied, we keep watching for confirmation. If the outside bar hasn't appeared yet, we continue waiting. We repeat this process each day until the setup is complete. In this example, the signal appears on day 7, so we enter the short trade, set the stop loss and take profit, and continue checking the chart once a day. After the first take profit is reached, we secure 50% of the position and trail the stop loss with the trend. As you can see, this strategy doesn't require you to watch the charts all day. You simply check the market once a day and follow the rules. That's the complete EMA swing trading strategy. The main idea is to wait for the price to pull back into the EMA channel before entering. If you'd like, you can combine it with other tools, such as Fibonacci retracement, to measure the depth of the pullback. However, this strategy only requires 2 EMA lines. The most important rule is that the price must not close beyond the EMA 50, because once it does, there's a much higher chance that the trend will continue in that direction. This technique is called ORB, or Opening Range Breakout. Let's meet this technique. Before we start today's video, if you'd like to receive offers on courses, exclusive tools and indicators from Rober, as well as market information and signals for gold and Forex, you can join the community via link pinned in video description. And of course, everything is completely free. ORB is a scalping trade technique. Mainly, we will focus when the market opens. During the opening of the market, there will be a very high volatility. And most of us will use this technique with the stock market at the time of New York. The stock market we use will be New York Stock Exchange, or NASDAQ. During the opening of the New York market, it will be the closing of the London market. Therefore, it will be a period of time when the market is stagnant and very volatile. When the price is very volatile, there is a chance to make a lot of profit. The graph will be like this. Suppose I have a line. This line divides yesterday's time and today's time. When the market opens, we will determine the period or range. This range is called the opening range. After we finish the period, we will consider that during this period, we will do the job like a channel. There is a bottom line and a bottom line at the top. The price has the opportunity to bounce back and forth around this channel. And the point that we are interested in entering the trade is the point where it breaks out or breaks through the bottom line. Next, you may have a question about the opening range. How much time do we use to schedule? Most investors will use the period at which the market is tense for only the first 15 minutes of each day. If it is a New York market, it will be from 9:3 a.m. to 9:45 a.m. There are many reasons why the market is tense at this time. It may be an order that has been held since the market closed, or in the past night, it has been reported by the economy. And another factor that cannot be overlooked is that the big price fluctuates in the first period of the day. I have an example for you to see. It is the opening of the market for 4 days. These 4 days will use the graph for 5 minutes. Therefore, when the market opens for the first 15 minutes, it will be equal to 3 bars. On the left-hand side, you will see that when the market opens, the first 3 bars have a lot of volatility. The price has dropped sharply. We can mark this range as it is. The second day is still the same. When it opens, there is a gap up. When it opens, the price goes down within 15 minutes. We also got a range. On the third day, we will go back. When the market opens, it will open low. But when it opens, the price will create a range in the positive direction. We also got another range. Finally, the market opens low and rises as well. We also got a range. These 4 examples, you will see that the price is very volatile in the first 15 minutes. After that, the price may bounce or break out. The important key of this technique is that we will not trade in the first 15 minutes. We are not sure what will happen in that period. The price may fluctuate, or it may be a fight between the financial institutions. Therefore, we will wait for the price to start steady and then find the time to enter the trade. Our setup will be divided into 3 steps. It may look a bit too much, but when trading, friends can do it quickly and find the time to enter the trade easily. The first step, we will look at the market trend in the overall picture first. This step we will use at the time frame of 15 minutes. Buy, we will see that the market is up or down. After that, we will look at the trend in the past. Most of us will look back 2 to 3 days. And finally, we will determine the range of the first bar or when it passes 15 minutes after the market opens. The method is according to this graph. The time frame is 15 minutes. Let's divide the day. For example, I have the day before and yesterday compared to today for you to see. Now it's 9:03 p.m. The market is just starting to open. We will look at the trend of the day before and look at the important trend. For example, on the day before, the price has risen, then the long sideways. Therefore, it is an important resistance. After a while, the price went up and went down again, but did not go further. Therefore, this area is also a resistance. In general, the old resistance has now turned into a resistance. We can mark the position. In addition, if you look at the high position of the previous day, the price rises and bounces down, there is a small trend. After a while, when the new day begins, this trend has become a trend. The price rises and rises. The moment it rises, it comes back to test at the same trend, which is now turned into a trend. We can draw another line. At the end of yesterday, half a day in the morning, the price was sideways. The price will go up or not. After half a day in the afternoon, the price went up and then went back up. When it went up, it was a fixed trend. Therefore, the original trend has now become a fixed trend. We got the key level out. After that, we will determine the range of the first bar. After 15 minutes, now it's 9:03 a.m. The market has just opened. Wait for 15 minutes. The price has risen dramatically. It has turned into 9:45 a.m. Therefore, we can determine the range at the first stop. This range will be measured from the high point to the low point. We call it opening range. And the upper side of the range and the lower side, we will call opening range high and opening range low. Use the symbol ORH and ORL. The next step, the second step, we will check that the range we just drew, is it big enough? If the size is big enough, it means that the market is very competitive. The big line may leave a mark so that we can trade with it. We will go back to the 1-day time frame. We will check the range of the stock in the first step to see how big it is compared to yesterday's ATR. If you remember, ATR tells the market performance. We have to look at how much today's trading performance is compared to yesterday. And to get through today's gain, there must be more than 1.4% of ATR gain yesterday. Let's take a look at the example to make it easier to see. This example is the range that we have specified in the first step. We will check whether the range of this tank is large enough. If it is large enough, it may be the price of the large line itself. In this example, the range of the first tank is about $5. After that, we will go back to the ATR of yesterday. I will show you the graph on the left. This graph is a one-day time frame. Therefore, each column is the price movement yesterday and the day before. At the bottom is the ATR that measures the price fluctuation. We will focus on yesterday's column. This column, we will look at the ATR. We will read its value, which when we read it, we got a price of about $6. At this point, we almost don't have to check anymore. The first range of today is $5. Very profitable, similar to the price movement yesterday. Therefore, today's opening range will actually pass the gain. But for you to see the picture, let me calculate a little bit. Yesterday's ATR was blue, about $6. 25% of ATR, or 1 in 4, is about $1.5. Our gain said that today's opening range will be wider than 25% of ATR. After comparing, we will find that $5 is more than $1.5. Therefore, today's yellow has more value than yesterday's blue. It is considered that through gain, we can find the time to enter the trade in the third step. The third step is to enter the entry and exit the trade. The time frame will change to 5 minutes, and we will try to enter the trade within the first 2 hours of the day. The market opened at 9.3 the first 15 minutes. After that, we will wait until 11.3 to enter the trade. For the original opening range breakout, they will trade only breakout. But I have divided this technique into 3 types. 3 types will have a normal breakout, a breakout, and pullback. We also have a reverse or return price. For this clip, we will focus on the breakout only. For the next clip, the second one will be a pullback trade and a reverse trade. Let's take a look at the graph. Entry and exit, the first one or the breakout. The first step, we have a blue bar, right? This bar is the bar that opens at 9.3 to 9.45. We will get a range. After that, we will change the time frame to 5 minutes. After changing, bar 1 will become bar 3. 5 minutes per bar, 3 bars is 15 minutes. And we will wait for the time. Wait for the price to bounce back and forth until it breaks through the range. The moment it breaks through, we will find the moment to enter the trade. The second pattern, the pullback technique, the idea is the same. We got the range first, change the time frame. After that, we wait for the price to break out. When the price breaks out at this point, we will not enter the trade. We will wait for the price to pull back and test the resistance. The old resistance is now a resistance. We can find the time to enter the trade. The last pattern is a reverse trade or a return trade. At first, when the market opened, it was a big green bar. The price really broke out. But it's a fake breakout. The price goes up and down. Therefore, we can find the opening time after the fall breakout. Today, I have 4 examples for you to see. These 4 examples will be a model of a single breakout trade. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. Let's meet the first example. First, I will mark the day before to compare to see 3 days in a row. There was a day before, yesterday and today when the market was opening. If you look at the trend, we will see that the past 2 to 3 days, there was a trend of the market to rise. After that, when the market opened for 15 minutes, we got a red dot, 1 dot. This dot, we will determine the range from the top to the bottom. After we have determined, we will check the 25% ATR gain, which, all 4 examples, I have checked the gain, and it passed the gain. Therefore, I will not show the time when we check the gain. After checking, we will change the time frame to 5 minutes. From 1 bar, it will turn into 3 bars like this. Once we get the range, we will drag the edge to the length of 11.3. During this 2 hours, we will find the time to enter the breakout trade. Because this example is an upward market, we will trade only on the buy side. Wait for the breakout to occur in the next week, which is enough to wait for the price to come out like this. Below, you will see that the price has gone down, but we don't count. We don't set it to be a breakout. We will count when the price closes outside the range. As for the upper side, it is not set to be a breakout either, because the price has not yet closed the upper range. We have to wait. Wait a little longer, the price will break out. When it breaks out, it closes the upper range, which is considered through the gain. This bar I call the first bar. We will not buy immediately. We will wait for another bar to turn green as well. When there are 2 green bars, we can find the time to buy. The reason why there must be 2 bars is because there are many times that the first bar breaks out, but when it is the second bar, it goes back down immediately. If we buy at the first bar, there is a chance to lose money when the price goes down in the second bar. But in this example, there are 2 green bars attached to each other. We can place a buy. Next, we will place a stop loss. Our stop loss will be at the top range or opening range high. After we get a stop loss, we will place a TP with at least 2 to 1 RR. TP will be like this, which is quite far. Once we enter the order, we just wait for the price to go up until it hits TP. We sell it out and get 1 profit. The next example is still a market. I want to divide the day into 3 days as before. The day before, at first, the price went down and rebounded back up. As for yesterday, the price hesitated to go up. Decided to be sideways. Therefore, we try to find the trend of yesterday and the day before. Take it as a reference point, which in this place, we look at the high side first. Yesterday and yesterday, the price tried to go up but couldn't go up. Therefore, this area is decided to be an important trend, may have an effect, according to today's price movement. And when it's been 15 minutes, 9:45 a.m., we got 1 red diamond. This diamond is set to range as before and check to see if it's big enough. After checking through the gain, we change the time frame to 5 minutes. As before, from 1 red diamond, now it is turned into 3 bars. At this point, there is an important resistance from the 1 5-minute time frame that we set at the beginning. And we will set the time to enter the trade at 11:3. Don't forget, because in the previous day, there was an uptrend in the milk market, and yesterday it was not decided. Therefore, in the overall picture, it is still up. We will enter the trade on the buy side only. Next, we will wait for the breakout to occur in the week. In this example, just wait 10 minutes. The price has risen to the first bar. We will not buy yet. We will buy when the next bar is green, which is the second bar here. The second tank is very important because the price is important. Therefore, the price has a chance to break out and go up for a long time. We will buy according to the system when the second tank is over. I bought it as before. Set the stop loss at the top range, which is this zone. After we get the stop loss, we will set the take profit to have at least 2 to 1. At this point, it will be like this. After that, we wait for the price to go up to TP. This example has an interesting point. The price does not go up immediately, but the pullback returns to the important trend. Now the trend is doing the job as a trend, and the price goes up to our TP. Then we sell it for profit as before. The third example will be the fall. We're at the time frame of 15 minutes. Divide the day into 3 days, as before yesterday and today, when the market opened. Looking at the trend, we found that it was a downward trend, and most importantly, there is one trend. This point is the trend of both the day before and yesterday. Therefore, it is an important trend to keep an eye on. After 15 minutes, the market opened. There was a lot of speculation. There was a fight between buyers and sellers. The price is only a long skyline, both above and below. We do the same step and set the range in the first 15 minutes. Don't forget, we have to check the gain first so that it passes the ATR gain. After passing, we will change the time frame to a smaller time frame. After changing, the appearance will be like this. Don't forget, we have an important trend, not close, not far. After that, we set the time to enter the trade until 11:3 a.m. As usual. A little more. Because it is a market, we will trade only on the sell side. We will wait for the price to break out in the trend and then enter the trade. Which, just wait a minute. Within 5 minutes, the price will break out. It is the first bar. We will open a short or trade on the sell side. When the 2 red bars are connected, the second bar is also red. Therefore, through the gain, and most importantly, it also reflects the trend. Therefore, we can open the shot comfortably at this position. After opening, we set the stop loss at the lower range or opening range low, which is a little bit far in this place, but for safety, we have to set it according to the system. Finally, we will set take profit at least 2 to 1, which in this place, it will be removed. Once we get take profit, we will wait for the price to go down until it reaches take profit. This example has a little hesitation to pull back, but in the end, it goes down for a long time and gets profit as well. The last example for this clip is a down market in the 1-5 minute time frame. Divide the day to see the trend first. It is clear that it is a down market from the day before until yesterday. After we get the trend, we wait for the market to fight before the first 15 minutes, 9.45. We mark the position to get our range. After that, we will check the gain that it is enough for trading today. After checking, we will change the time frame to 5 minutes. From a large red bar, after changing, it becomes a 3 bars bar. We set the time to enter the trade at 11.3 as before. After that, we will wait for the price to break out in the week, which in this case, the price breaks out immediately, but it's not as intense as the previous example. It's okay. Our system, number 1, at the breakout, we will wait to open the shot. When it is a red diamond, 2 diamonds are stuck together. The second diamond is really stuck together, so we can find the time to open the shot, which is around here. Our stop loss, if it is the same system, will have to open the bottom of the range. But because it is close to the point where we open the shot too much, therefore we will move our stop loss to be farther than before. In this place, we will use the high of the second bar, which is this bar that we open the shot. When we get the stop loss, we will prepare to take profit. Take profit as before, at least 2 to 1. In this place, because of stop loss, it's short. Take profit is not far away. From the example that I see with my eyes, it should be RR 3 to 1. After everything is done, we wait for the price to go down to TP. This example has already made a profit at 3 to 1, but if friends set it further, there is also a chance to make a profit. In conclusion, opening range breakout is a formula for using 1 trade when the market opens. In the first 15 minutes, we set the range to enter the trade, but not yet trade. Wait a while for the price to calm down. Once the price is calm, we will enter the trade back breakout according to the trend of the past day. For the next clip, I will take you to see a pullback trade and a reverse trade. Don't miss it. Stay tuned to our YouTube channel for today. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.